Are bonds a safer choice, or are stocks the only path to real wealth? This is a debate that has puzzled and inspired investors for decades. The decision between bonds and stocks depends on your financial goals, risk tolerance, and investment timeline. Let's break it down to help you make the smartest choice. What are stocks and bonds? Stocks. When you buy a stock, you're purchasing partial ownership in a company. Your return comes from dividends, if offered, and the appreciation of the stock's price. Bonds. A bond is essentially a loan you give to a government or corporation. In return, they pay you interest periodically, and your principal is returned when the bond matures. Pros and cons of investing in stocks. Pros. Higher growth potential. Historically, stocks have offered the highest returns among all asset classes. Ownership benefits. Stocks provide an opportunity to share in a company's success. Liquidity. Most stocks can be quickly bought or sold on the stock market. Cons. Volatility. Stock prices can swing dramatically due to market conditions. Risk of loss. If a company underperforms or goes bankrupt, you can lose your entire investment. Emotional challenges. The stock market's ups and downs can lead to impulsive decisions. Pros and cons of investing in bonds. Pros. Stability. Bonds are less volatile than stocks and provide predictable income through interest payments. Capital preservation. High-quality bonds, such as U.S. Treasury bonds, are considered safe investments. Diversification. Adding bonds to your portfolio reduces overall risk. Cons. Lower returns. Bond returns are typically lower than stocks over the long term. Inflation risk. The fixed income from bonds can lose value as inflation rises. Interest rate sensitivity. Bond prices fall when interest rates rise, which can reduce their resale value. Who should invest in stocks? Risk takers. Stocks are ideal for those willing to endure short-term volatility for the chance of higher long-term gains. Long-term investors. If you don't need your money for 10+ years, stocks give you time to ride out market dips. Growth seekers. Stocks are perfect for growing wealth rather than preserving it. Who should invest in bonds? Conservative investors. Bonds are best for those who prioritize stability and consistent income over high returns. Retirees. Bonds provide a reliable income stream for those no longer working. Short-term goals. If you'll need your money within a few years, bonds can protect your capital better than stocks. Should you choose one or both? Most experts, including renowned investors like Benjamin Graham and Warren Buffett, recommend a balanced portfolio. The mix of stocks and bonds depends on factors like your age, risk tolerance, and financial goals. A common rule of thumb is the 100-age rule. Subtract your age from 100 to determine the percentage of your portfolio to allocate to stocks. The rest goes to bonds. Example: a 30-year-old might invest 70% in stocks and 30% in bonds. A 60-year-old might choose 40% stocks and 60% bonds. Both stocks and bonds have unique roles in building wealth. Stocks offer growth and wealth creation, while bonds provide safety and stability. The best strategy? Combine them to create a diversified portfolio that grows steadily while minimizing risks. Help you clarify your investment strategy? Subscribe to our page for more financial insights, and share this with your friends to help them make smarter investment choices.